we've been on the radio often together over the years. I don't know for how many years, but I've never had a chance to speak here. And I really am honored that they chose us. And, these conferences are basically about money. So what I'm going to do now is just give Michael money.
Oh, that's never a bad idea.
Hopefully this will make him very happy.
It really does, because who doesn't want a 10 peso bill from Argentina?
That's right.
Who doesn't want that? Come on, Vince, thank you.
Don't spend it all in one place.
Sadly, that's the best gift I've had this year.
Okay. Let's see if I've got this correct. I think that's the one to go. Excellent. All right. So I am a contrarian. Some people seem to think I'm at the top of the heap in Canada and North America. I won't talk about all the mistakes we've made over the 30 years we've been doing the investment ladder. I've been investing since I was a teenager. I started when I was about 18, 19, 20, putting money into stocks. Some of my first ones were Liberian Iron Ore, which probably none of you know, and Exxon Corporation. So how do you learn about investing? People often ask me. You learn by what you do well, but probably you learn a lot more by your mistakes. And I know a lot of people who will say that they really don't make mistakes. And I've had people say, when you're on BNN, you talk most of the time about your mistakes. Why do you do that when you've got such a great track record? And I don't know, maybe it's because I grew up with 3 older sisters. So, they were always pushing me down all the time. Maybe that's part of it. But learning from your mistakes is absolutely critical. Anyhow, I'll probably do a few segues here. I'm always curious to hear what I'm going to say when I speak. I do quite a bit of speaking, and on which tangents I might go. And often I don't even have this as a guide. So some quotes: the Globe and Mail, Bench Gallagher is widely considered to be Canada's top authority on contrarian investing. The National Post, Fall the World's a Stage, the Bench Gallagher is one of the market's greatest characters. I think when they wrote it, because I've written 6 plays that have been on the stage, and myself and my business partner, Ben Stadelman, with 3 other friends, we started one of Canada's largest theater festival called Summerworks in 1991. It still goes on today. So I think that's where they got it. Market Masters interviews with Canada's top investors, proven investing strategies you can apply. Bench was number 1 of 28 on the list. So I still eat at McDonald's. See if I get this right. Yes. So I don't know how many of you know this guy, Warren Buffett. I've been to Nebraska for his meetings twice. I was there about 15 years ago. I went with my business partner, Ben Stadelman. And then last May, I took my 2 lads who were 22 and 19 at the time. And I thought, we better go soon. Because if we don't go soon, it's quite possible that either Warren or Charlie will no longer be with us. And as you probably know, Charlie died in the past year. And these guys are brilliant investors. They also seem to be quite humble. You got a lot of guys out there, a lot of people in this field, and they're egomaniacs. I would say, well, I won't say it. But a lot of them aren't very nice people, and who they're looking after is themselves. And that's what they do, and you have to watch it. I think you all know there's a lot of charlatans out there. And the only thing they really want to do is take your money. So when you've got guys like Warren and Charlie, down-to-earth individuals, honest individuals, it's a wonderful thing. So Warren said, I will tell you how to become rich. Close the doors, be fearful when others are greedy, be greedy when others are fearful. And we're contrarians. We tend to go against the grain. That doesn't mean we always go against the grain and we're just trying to be disagreeable. But what we're trying to do is, you'll see as we go on in the presentation, We're trying to buy into companies that have had the crap kicked out of them. And then I'm looking at 100, 2, 3, 4, 500% plus as potential returns. And none of it's pie in the sky. Every company that I buy into has been listed for at least 10 years. So because it's been listed for at least 10 years, I've got a track record to go on. And I always get asked, how do you set your initial sell targets, which I do whenever I buy into a company. It's always based on where the company has been historically. Since there's no questions today, I'll just go into it a bit. So often my company's been badly beaten up, but I can see in 7 or 8 of the past 10 years, it's traded much higher levels again, 2, 3, 400% higher. Or it can be a bit different. It could be a spiky chart. So over the past 10 years, maybe it's gone from $5 to $12 plus 3 times in 10 years. That's an indicator that it might do it again. And somebody was talking to me about Alpha Pro Tech the other day, which we made a fortune on. And it seems like every 5 years or so, the stock just goes absolutely crazy because of the field that they're in. George Soros, another great investor. It's not whether you're right or wrong that's important, but how much money you make when you're right, and how much you lose when you're wrong. And a lot of people think you have to be correct 50% of the time to make money in the stock market. That's not true. Because of what we do, because we're looking at having such amplified gains, we could be right probably 30% of the time. That doesn't mean that I shoot for 30%. But you can do very well being wrong most of the time. But again, what I'm always trying to do is be right most of the time. And it's very important, though, to understand how fallible we can be. But very, very interesting. Good. We get lost. So we have our philosophies, and you decide to go to our website, contrarion.com, where it's spelled H-E-A-R-D. It has all of our philosophies. It has a lot of the articles. Ben, Phil, and myself. Phil, where are you? So Phil McKellar, he's been with us for 10 years plus. He's actually from Victoria. I think he's mid-30s now. I like to think he's learned a fair bit from Ben and myself. He also does way more reading than I do, but I do an awful lot of reading. You know, Warren and Charlie, they did a lot of reading. One of the best things you can do is read an awful lot. And at the back of my 2 stock books, there is a biography of so many of the books that I've read over the years about investing. I also read a lot of books about other things, and I should read even more. I could not spend so much time watching television, which this could be bad to say, I actually like to do. I love lying on the couch and watching television. I have to cut it back. I think maybe that's what I'm going to make as my modus operandi when I go back to Toronto. Of course, February in Toronto, it's a good time to watch TV. Our philosophy: concentrate on turnaround situations and stocks which are currently unpopular but are likely to regain their luster. Now, you might have noticed something different between what I've got on these boards and what other people have on the boards. I used to have better than 20/20 eyesight, as does my youngest son. Unfortunately, what's happened over the years is my eyesight has gotten a lot worse. I can still see, but I can't see it all like before. So I really like the way this has turned out. I can be here without my glasses on and read what's there. So we concentrate on turnaround situations and stocks, unpopular but unlikely to regain their luster. Now, likely could be actually too strong a word. And then I think it's pretty fair overall. I mean, we're certainly right far more often than we're wrong. But I got asked years ago, how long before your stocks go and hit your initial sell target? Again, we're talking double, triple, quadruple. And at one point I went over our investments over a number of years, and it was a reasonable percentage, but it was the time. 3 years, 4 years, 5 years, 6 years. I invested in 2 funeral companies, Service and Stewart, 2 largest funeral companies in the world at the time. Being a very optimistic person, I thought I should invest in funeral companies and cemeteries. And in both those cases, my sell target was 400 or 500% above where I was buying it at $3, $4, $5, buying them. And for 3, 4 years, they did very poorly. They did not move up a lot. As a matter of fact, Stewart did something that was considered to be wrong. They went into one of their cemeteries, not making this up, and they took a bunch of bodies and moved them so that they could put other bodies in their place. Now, some people got upset about this, and when it came out, the stock took a real beating. But I have a tremendous belief that the general memory of the population is not that long, and things will change. Now, when people are dead, their memory might actually be longer. I have no idea. But anyhow, those stocks turned around. And it took a number of years, but they were paying dividends. And I don't know if I have it on one of these slides, but one thing I like to say is dividends allow me to be stupid longer. And if you've seen me on BNN every once in a while, I say it. They do. If I'm collecting 2, 3, 4%, even if the stock isn't doing anything or going down, at least I'm getting some sort of return. And a lot of people think you're a contrarian. Why would you even go for dividends? And I would say about 2/3 of my stocks pay a dividend. Again, I can sit back, clip the coupons. It allows me to make money while doing nothing. So I love stocks pay dividends. One good way of investing, if you have companies that are paying dividends and they get into financial difficulty and they eliminate the dividend, often after the stocks then take a beating for the most part, but often they'll reinstate the dividend when things turn around. And then, of course, the stock price generally goes up. One thing to be wary of, and another binge calendar tangent, when a company slashes a dividend and it not eliminates, often they find they didn't slash it enough. So often then they end up slashing it again or eliminating it. So I have learned over the years, one of the mistakes that I often made was I would buy into companies that paid fantastic dividends. Of course, it's percentage wise. And I'd be getting 8, 9, 10, 11%. And sometimes that would last for a few months. And then they would slash or eliminate the dividend. So one thing to be wary of is if you're looking to buy into a company, if it has a really high dividend, you probably don't want to buy in right away. You probably want to wait. And we'll just go back and forth, throw a little here, throw a little there. So we carefully analyze corporations' financial statements, concentrating on debt ratios and book values. So we look at numbers. We like numbers. Phil is great with numbers. My business partner, Ben Stadelman, is great with numbers, and I'm not too bad. Sunday mornings with my dad, we would often go to Sherman's Bakery in Toronto, and he would grill me on mathematics. So 1 + 1, 1 + 3, 1 + 4, which at that stage of my life was being grilled. But I sometimes got it right. Get off my case. But I always liked numbers. So it's very, very important. And one of the things I learned, because of one of the mistakes that I regularly made, was I would buy into companies that had too much debt. Debt can kill. It can not only kill you as a person, and I'm figurative here, it can kill companies. So I try and avoid debt to a degree. I'm okay if the debt level is reasonable and I do it relative to revenues. I'm okay if the debt level has stabilized. But if I see the debt level going up and up and up, even though the company has great reason supposedly for it, to me, that's a big red flag. So debt levels are exceedingly important. Sometimes I manage to buy companies that don't have any debt at all, long-term debt. And I know that the odds of them having difficulties are very, very low. Now, as I say that, I remember one called Glendale, and they made vans. Zero debt. Zero debt load. This is great investment. Bange Gallagher was super happy. So I bought in, and about a year and a half later, management said, enough, we're not doing very well. Gas prices were too high, recession was on, they closed down the company. So I got back zero. And I have a rating system, 1 to 4. 4, I will put in 4 times as much money as a 1 when I'm more certain. I don't remember the exact weighting that I used on that, but it wasn't pretty. Analyze management's ability to achieve stated goals. So I will talk to management, try and get a feel for management. I don't do it in all cases. In Canada, management is always very happy to talk to me, it seems. In the States, often they don't know me, but often they'll talk to me. There's a flip side to this. So if you get too close to management, you often will believe what management is saying when they're full of BS. And it's a real danger, and I've had that happen to me before. So how do you take that correct distance while trying to get information? It's not always so easy. And that's so much about investing. Some people want this perfect model, and I don't have it. I'm sure you'll find some people who will tell you they have a perfect model and just give me $20, $50, $100,000 and I will make you so much money, and then maybe they'll disappear. Invest only in corporate organizations that have been around for at least 10 years. So we talked about that before. I want that data. And the longer that corporations have been around, ceteris paribus, all things being equal, the better chance normally they would have a hit. Again, doesn't work all the time. What's the next one? So often pick takeover candidates well before takeovers occur for near optimal returns. Almost every single year that we've been doing the investment ladder, almost every single year of the 45 or so that I've been doing this, I've had 1 or 2 takeovers anyhow. One year we had 5. Takeovers are almost always done at a premium. Sometimes it's a small premium, and I'll say small 8 to 10%. Sometimes it's much larger, 50 to 100%. I was recently looking at Indigo, wish I'd bought it, but everybody was saying how awful it was, and I've been to Jerry Schwartz's house a couple times for meeting, Heather Reisman's house, but I didn't pull the plug. And most of the time, most of the stocks I don't buy a lot of stocks. I probably buy maybe 5 to 10 stocks a year. It's not important buying a lot. The question is how well you do on the stocks you actually buy. Normally sell a minimum 50% of a stock upon achievement of our target while market timing the rest. So because I've set an initial sell target, that grounds me. If the stock hits the sell target in December, odds are I won't sell it. The reason being, I want to defer taxation. It's better for me to defer it to the following year than to pay it in this year. And a lot of the stuff I do, it's always the same. So I'm deferring taxation that way. But normally I sell minimum 50%, the odd time less, but it's rare, or even 100%. So again, part of it is because I know how fallible I can potentially be. practice patient investing while ignoring the daily pulse of the market. I read the Globe and Mail newspaper every day. We write a column, the Contra guys. We're normally in the Globe about every 3 weeks. But too often people get caught up in the daily minutiae of the market. Here's why the market went up today. Here's why the market went down today. So they always have to come up with reasons that these things happen. Now, I'm not saying pish posh to the reasons, but a lot of the reasons aren't really very important. But they always want to tell you something. So I try and avoid it. Matter of fact, at one point I had the best returns ever was when I went over to work in what was called Czechoslovakia. That was in '92. And it was very hard to get information. The internet was just starting. Czechoslovakia was behind in terms of technology. I would see the Financial Times out of England once a week, and to me that was exciting. But practice patient investing while ignoring the daily pulse of the market. Advocate diversification. So the question is, what is an adequately diversified portfolio? And you'll get a lot of different answers on this. I would say kind of minimum 6 stocks, maybe up to 25, 30 stocks. Sometimes what I do after the big banking crisis in the States, I bought 5 US banks. So I was diversified within the sector. And quite frankly, I think I got lucky because they all did well, although it took time. And when I bought into Bank of America at $6 and change, I owned Bank of America twice, some people were saying it's going to go under. And there's complexity in investing and simplicity. A key reason I thought that it wouldn't go under, this may sound stupid, was because it was the Bank of America. If the Bank of America goes under, what's happened to America? So there were other reasons too. Now the CEO who came in, he was fabulous. But that was a big part of it. And the States as a country has a very, very big ego. If you put them all together, we're the greatest country in the world. I love it all the time. We're the greatest country in the world. Maybe they are. We're not by my standards, but what do I know? I'm a contrarian. Anyhow, by spreading out into different banks, I made the risk lower. Advocate diversification, appreciate stocks, pay regular dividends. I already touched on that. Now, what I'll talk about, once I discover a stock, so to speak, I do a filter about every 4 to 6 months. I go through every stock in the States, not counting the OTC. I go through every stock on the TSX. And I look for the stocks that are down at least 33% in the past 52 weeks. And it used to be different because we didn't have computers for this stuff. I remember flying overseas and I would literally be going check, and going line by line by line. So it's changed. It's a lot easier to do things now. There's a lot of good filters. And one of my uncles who was a stockbroker, he would spend about 4 hours a day going through each of the stocks. And I said to him later in his life, you can get a computer to do exactly what you're doing. And you wouldn't lose anything, really. I didn't. He disagreed, and that's fine. So here are 3 of my best-selling books. The Uncommon Investor 3, it's had 3 editions. They're all gone, so you can't get them. The Canadian Small Business Survival Guide, it first came out in '88. It has since done very, very well. It's been updated to some degree. I still have a lot of pride, and they gave me $500 as an advance. Cha-ching, cha-ching. But it was great. It was great. And I actually have that book here. and I'm going to be sitting at the reception where you come in if anybody wants to buy it. And then the Contrarion Investors 13 also became a bestseller. I only have hardcovers now. I had soft covers before, but I've sold them all. So I brought the hardcovers, which might be why you see me kind of walking like this, because my bag is full. So again, I'm going to go sit outside after this if anybody wants to buy it. That one's $40. I'm happy to sign it, dedicate it for anybody. Some people will say that, people who know me well will say, well, that lowers the value. So if you would prefer that I don't do it, that's fine. I remember actually when I was speaking out in Vancouver a number of years ago, and I haven't been here since the pandemic, and one of my sisters lived in Vancouver, Victoria. My brother-in-law is here, actually came out, we just had lunch, and I love coming here. But again, it's been a number of years. That's one of the reasons I'm so grateful that they actually invited me. I think it's more slides. Hello? Yeah. So I was told people like stock picks. I'm going to give you some stock picks. So Akita is a driller, oil and gas. I don't know where it finished last week. I think it was about $1.50. My initial sell target's $8.44. So this is the kind of thing that we do. Corby, for you people who like drinking, even for you people who don't like drinking. Some people say alcohol stocks are the best place to invest because if people are celebrating, they want alcohol. People are unhappy, they want alcohol. It's not quite that simplistic because when money's being sucked away from you, but Corby's a good company, good balance sheet. Laurentian Bank, it was funny because right after I bought Laurentian, there was talk of a takeover. The stock went way up, and for a little bit I looked really smart. And then it didn't happen, so the stock went from, I forget how high it was, I think in the 40s back to 20s, paid I think 32, 33. It's a good bank. I spend a certain amount of time in Quebec where we have a chalet. It pays a dividend, and then it did what banks never do. They cut the dividend way back. They didn't eliminate it, but they cut it way back. Well, again, stocks cut dividends, they go way down. Some people like little gold companies. So Urbana is the quintessential little gold company. It doesn't trade very much too, so that's a risk. I bought it, I sold a bunch of it. But it is very, very small, but they actually do drilling and they actually have revenues. VLAN, again, I was looking really smart on this. I bought it about $5. There was a takeover in the double digits. A company out of France, but then the French government stepped in and they said, no, sorry, not happening. So I'm still holding. So I went, great, so smart. Not so smart. What can I say? Timing's perfect. ABEV, it's actually AmBev. ABEV is a symbol. Huge brewer out of Brazil. All kinds of names that you would know. They also do juices. Good balance sheet. I like this company a lot. It's trading around 260, I guess, so kind of looking at around a double. China Automotive. Guess what country it's based in? Some people will avoid China altogether because of the geopolitical risk. And when I have my 1-to-4 system that I mentioned before, I would invest less because it's in China. But this company I owned before, I sold it and did really, really well. And then I bought back in. RPC, they've been around a very, very long time. And this is a good multiple for this company. Santander is a Spanish bank, biggest Spanish bank. It's a huge bank. When I was in Portugal for 4 weeks, October, November, they have them all over there. They have them here. So very, very successful bank. And I was buying it at $3 and change, I think. and Telefonica, another Spanish company, telecommunications company. Now, these companies in telecommunications are usually fairly highly leveraged, and that's the nature of the beast. And when you're buying any company, you have to think what industry are they in, what are the standards for the financial statements and that kind of thing. So what I'm going to do after this, after Michael kicks me off the stage, I paid him money and I know he's going to kick me off the stage. I will go up to the front around the corner if anybody wants to buy a book or you just want to ask questions and talk. And then I'm back here for the panel in a little while. I have 2 seconds left. Thank you. Thank you. Thank you all.